On board Mark Mathhews, Head of Investment Research at Julius Baer, joining us on the show right now. Hi, Mark. Great to be speaking with you, and welcome to ET Now. Firstly, help us with your take on the markets, and especially how do you see Indian markets shaping up? Because we have been doing pretty well. Nifty is at an 8-month high. Nifty Bank very close to its all-time high levels, and even the broader markets are participating. Do you believe that the worst is behind for us when it comes to the tariff concerns, earnings not doing that well? What's your sense, Mark?
Generally, in the world, I think the tariff news is moving from escalation to de-escalation. Most importantly, the U.S.-China relationship, that is improving. But with India, I think there were hopes that a deal would be struck by the end of this month, and I don't know how much the market has priced that in. I haven't heard any news about it happening. There's obviously this big sticking point about access to the Indian market for U.S. agriculture companies. And I understand why that's sensitive for India, because there are a lot of jobs that could be lost in the rural areas if you open that market to the outside world. So anyway, I don't know. I don't think tariffs are going to move the needle that much. The biggest thing will be the earnings, which you mentioned. And typically in India, the earnings accelerate in the second half of the year. So I'm not expecting double-digit earnings for the April to June quarter, but I do think that if it's anything less than high single digits, the market will be disappointed because it's not particularly cheap. As you probably know, it's on around 21 times price to earnings. So we do need some earnings to bring that price to earnings ratio down.
Okay, Mark, appreciate that view coming in, but also want to get a sense of what you are making of this entire US-China trade deal. And you spoke about the India impact in terms of markets, but when it comes to some of these issues like tariffs or rare earth metals, where do you believe India stands, if at all, to gain from all of this? Can we see, or can we expect some global decoupling coming in towards China, or global delinking rather coming in towards China, now that other countries could consolidate to get a better share of REMs?
Yes, possibly. I mean, the tariffs that the U.S. has on Chinese imported goods were 30% until a couple of days ago. Now they've gone up to 55%. So that's a very, very high number. And where companies can substitute from other sources, I'm sure they will try. Now, I would also add that Secretary of the Treasury, Scott Bessent, said that this is a preliminary deal, and both sides are willing to continue to negotiate to get a permanent deal where the numbers are lower. So I don't think that 55% is the final number with China. But I do think that when all is said and done, when the dust is settled, the tariff on Indian imports into the US will be lower than Chinese ones. Now, if I just sort of bring that back to markets, I actually don't think the markets are that fussed about this because exports are not really that important for the Chinese economy anymore. And by the way, as you know, they're not for India either. So this creates a lot of noise, but I don't know at the end of the day how much does it really hurt or help either country's GDP. And the Chinese market is one of the best markets in the world so far this year. The Hong Kong market is up about 20%. Last year it was also up about 25%. So China is really back on the map, and Bank of America hosted a conference last month in Shanghai where many investors from around the world went to Shanghai, and many of them had not visited China since before COVID. So the fact they were willing to get on an airplane and go all the way to the other side of the world shows that many people are willing to be constructive on China and view it as investable again.
Absolutely. Mark, let's discuss
perhaps what would have bigger implication on economies like India. What's happening now in West Asia between Iran and Iraq and the kind of ramifications it's having on crude. The geopolitical implications aside, because that we've seen the world somehow deals with, started off with Russia, Ukraine, got on to Israel and Gaza, and now between Iran and Iraq. But especially the kind of ramifications it's having for crude and then importers like India eventually.
My understanding is, I don't want to say the numbers because I haven't looked at them in a while, but Iranian output can be matched by an increase in production in other oil-producing countries like Saudi Arabia, like the Emirates. So if there was an event like Israel attacking Iran, and somehow that took Iranian exports offline, very swiftly you would get a response from the other oil-producing countries. But I would say that apart from 2024, there never has been a direct attack on Iran from Israel, and 2024 was in response to missiles that Iran sent to Israel. So it would be a very big deal, and it looks like it's going to happen. I'm sorry to say, of course, I wish it wasn't, but the Americans have withdrawn non-essential staff from their embassies in the Middle East, and CBS News is reporting that Israel's ready to attack Iran. The posturing seems to be very aggressive, and I don't think Donald Trump wants this at all, but the pressure on him is enormous. So you're right to raise this as a concern.
And Mark, while we are talking about Donald Trump, earlier this morning we've had comments wherein he has said that he is going to be setting unilateral tariffs once again in a span of about 2 weeks from now. This is something that he had said in the middle of May as well, and it's not shown through. If at all this statement were to hold up and he does come out with a new list of unilateral tariffs once again, do you believe the global economy is headed for yet another round of uncertainty like we saw when the first round of tariffs happened, or do you believe the markets are better equipped this time around and maybe this uncertainty is already priced in?
Yes, I think both the economies and markets of the world are more immune to this. Donald Trump said a few weeks ago that he would impose a 50% tariff on the European Union and a 50% tariff on steel and aluminum imports and a 25% tariff on Apple products unless they make iPhones in the United States. And the market has just gone higher since then. So the market's immune and the economy seems to be too. I'm a little curious why, but there's no softness in really any data in the world that reflects deterioration in trade or investment or consumption because of the tariffs. In fact, most of the data in May and preliminary data that we have for so far this month shows a significant improvement over April. I don't really know how to explain that because the issue is unresolved. But I guess the market feels that there will be tariffs at the end of the day, but not enough to really cause a recession. And that was the message from the big backpedaling that the Trump administration did after their infamous Liberation Day on April 2nd.
Mark, just quickly, if you can help us with your take on precious metals as well, because amidst all of that uncertainty yet again with respect to tariff, it's gold that is seen to be shining just when we were seeing some bit of a tapered down move there. Give us your sense on gold and how do you see the asset allocation moving ahead?
Well, gold is up, I think, about 28% so far this year, and it went up around 25% last year. So those are enormous moves in a 1.5 year period. And, you would think too much because over the last 100 years, the gold price has gone up about 5% per year on average in dollars. So a move of over 50% in a year and a half is too fast. And I think the reason for the move was, more than anything else, the idea that tariffs were going to cause China to devalue the renminbi in order to remain competitive. Now, clearly, that's not going to happen. So I would just say, it looks overbought. But I'll give you one anecdote, which I learned from the World Gold Council last year. They think that China wants to be the largest owner of gold in the world. The People's Bank of China currently has officially about 800 tons, something like that. Unofficially, it's probably 3,500 thereabouts. But the U.S. Treasury has over 8,000 tons. So if China really wants to be the largest owner of gold in the world, they have a long way to go to get there.
Okay. Oh, we'll keep tracking that. Just so many developments. But Mark, great to have you today on the show. Thank you for your time. Okay, let's move on and let's address firstly, very quickly, what's happening